All right, Mega team, welcome back to our channel. Thanks for tuning in to today's video. Today's video will be a Bitcoin update. We're going to be focusing more on the technical analysis today rather than the macro structures or market patterns or expected price targets. So we're going to run a technical analysis on the larger time frame, smaller time frame, and short term, and do a bit of a variety of different indicators, RSI, MACD, Ichimoku clouds, all those cool things to give it a little bit of understanding of, how is the price actually looking at these levels. Because we've talked a lot about where we think the price is going to be heading and why we think the price is bottoming or why it's not going to bottom or where it could go, etc. We're going to focus on how is it actually looking here, what are the technical indicators actually telling us here, and can we utilize these to support our current stance, which I've explained in previous videos. I'm also going to bring up a snippet from yesterday's video. It was about an 8-minute snippet. It's going to talk all about the economic state, how the economy affects Bitcoin, what we can expect going into the future, and how the economic situation can facilitate growth or hinder it. So we're going to put that near the end of the video, of course, and we'll go ahead and give you a little bit of a notice when we're going to put that up. Anyway, let's go ahead and dive right into the chart. So we're going to start on with the Bitcoin chart, of course, and we'll take a look at this chart over here. This is obviously the Bitcoin chart on Bitstamp on the 3-day chart, and we're just going to zoom out, and this is a couple of things we were annotating in yesterday's video, but essentially really quickly, descending channel, guys, lower end of the descending channel, bounced out with a nice long legged doji candle. We currently have 3-day candle close above, with our current 3-day candle closing in 1 day and 21 hours. We're above a major support zone, which is indicated by this gray zone, which is on the horizontal chart, on the standard chart, of course, which is looking really good, and that represented the all-time high in 2017, as well as that area of consolidation just before we went into this parabolic rally for Bitcoin in late 2020. Just to summarize where we are sitting, currently we are technically sitting right above that 2017 resistance, of course, support zone, and obviously resistance support zone in December. So looking how we are now over here, we're right above that support zone on that 7-day chart. We're not looking too shabby. But like I said, today's video isn't going to be talking about any of that. We're going to talk about what are the technicals saying, what is the likelihood we actually have some kind of bounce over here. We've already seen a 20% bounce, so it's pretty good. What are the likelihood, based on the technical indicators, that this bounce will grow into a macro trend reversal? And of course, we've talked about where that needs to occur. We have these lines on a chart. Of course, our first reversal occurs at this point here. Breaking this point will be our short-term reversal, looking pretty good. For a macro trend reversal, we need to break this level here. That would be the macro trend reversal, okay? So let's go ahead and start with some indicators. Let's go start with the Ichimoku cloud. And Ichimoku cloud on the 7-day, of course, isn't going to be telling us too much besides the fact that we are still aggressively downwards. We don't really have that reversal in yet. We're going to have to analyze the Ichimoku cloud on a smaller time frame. So we'll come back later on in the video in a few minutes when we go to a smaller time frame and talk a little bit more about the Ichimoku cloud on the smaller time frame. What it can tell us right now is it can tell us points of major resistance. So we can see points of major resistance, which is the conversion lines and the baseline. One good thing I would like to note is that these have actually ended up within this wedge now, within this descending channel, which is a good thing. They're not outside the channel, they're within the channel, meaning if we do eventually break this descending trend line, we will actually clear both these conversion and baselines over here, which acting as pretty significant resistance currently. So that's one thing. Of course, our lagging span is underneath the clouds, indicating that we are in fact obviously not only in a downtrend, we have this negative momentum. The momentum is not looking too favorable, so that will need to push upwards, of course, on the larger time frame for us to actually flip bullish again. All right, let's go ahead and talk about it on a 3-day chart. We'll break it down. Same thing over here is telling us exactly the same thing. Nothing else to really comment on the 3-day. On the 1-day, let's see if we can see anything else. 1 day looking a bit different here, guys. So we have broken over that conversion line, which is a weak entry signal. And the reason why it's a weak entry signal, because for it to be a strong entry signal, we need 3 things. We need the price to be 1, above the conversion line. 2, we need the momentum or the lagging span to be above the clouds. And we need the price to be above the clouds. So when all those 3 things occur, we have a stronger entry. Right now it's a weak entry. It doesn't mean it can't go up, but it is suggesting it's just a weak entry according to the Ichimoku cloud. Let's go ahead back to the larger time frame, and we'll bring up some of the indicators and come back to Ichimoku cloud on that small 4-hour later. So bull market support band, of course, real common one, pretty popular around in the market. A lot of people talk about it. I personally don't use it on the larger time frames. I like to use it on the smaller time frames, 1 day, 12 hours, 4 hours to scalp trade with. On the larger time frames, it just really doesn't tell you too much. It tells you one thing really, whether we're bullish or whether we're bearish. And although that's handy, it doesn't give you much to react with, because it is, at the end of the day, a descriptive analytical tool, not a predictive analytic tool or a prescriptive analytic tool. So a prescriptive analytic tool and predictive analytic tool, they tell you what is going to happen and how you should react. This is simply telling us what is happening. So it is less valuable than a lot of other indicators, particularly on the larger time frame when it moves out, but it still can be used to gauge the overall trend. And of course, it doesn't take a genius to understand we are underneath the bull market support band. We are technically in a downtrend. So 3-day, we will most likely still be under. Let's double check. We are technically still under. And 1 day, let's take a look. We are under. We do have some convergence here upwards. It's not looking too great. I'm going to go talk about it in a second. And obviously that bull market support band is coming pretty close to the price. If we go to a smaller time frame on the 12-hour, we might see anything different. Right here, this is pretty important, guys. The price is within the bull market support band. This is a no trade zone. If you're looking for long-term entries, this is not where you'd be wanting to do it. Long-term entries were down over here, like we said, for months and months and months. 18K was that major buy zone. Now, a break above this is going to indicate a potential move upwards. And I've already told my crypto channel and VIP channel, of course, I'm just going to quickly shout that out. If you're interested in joining the free channel, you can go ahead and join us over here. The link is in the description below. We do a variety of market updates, put all our videos in here, and a whole range of other things. And of course, we've already talked about that on here. And that is that analysis there. So if you're interested in getting some more analysis throughout the day, head over and join that link. So we're already back to this video over here. Of course, if we break above that bull market support band, we can see some kind of impulse upwards. And of course, if we go ahead and just draw that yellow line there and go back to that daily, we can kind of see where we expect. So that 12 hours over here, 1 day over here, that will give us to 23,500. Let's take a look what I said over here. And this said we will come up to, mid 22,000. So that'll be 22,500 over here. So it lines up with our resistance zones on our analysis in our Telegram channel. And we do have that bull market support band to confirm that is in fact the next resistance if we do clear the current range. So not looking too bad, guys, on the daily. Let's go back to the 7-day and we'll bring up our, let's go for our Gaussian channel. And I love the Gaussian channel, but you can see a lot of people said, oh, Gaussian channel flipped red. This is really, really bad. But like I said already in another video, it doesn't really mean much. What the Gaussian channel really tells us is it tells us where the price is heading, not what the price is actually doing. Very, very different, guys. So again, it's not a descriptive analytical tool. It's a predictive analytical tool. When you break into the Gaussian channel, all right, we generally see price movements throughout and downwards through the Gaussian channel, right? We got rejected over here, nice fake out, of course, and came back through. Now, if we flip it, guys, we can see something pretty interesting. When we see the price overextend above the Gaussian channel, at some point, it will have to retest the uptrending line or a downtrending line of the Gaussian channel. And when it breaks into the Gaussian channel, it is more likely to follow through the bottom of the Gaussian channel. So that's how the Gaussian channel works. I'm not saying that's going to happen like that. That's generally how it works. So you see that play out on smaller time frames much more frequently. I'm going to show you on a larger time frame in a second. Let's go ahead and actually do that now. So we bring up the Gaussian channel on the 7-day chart. We can see something really interesting. We can see that on the macro scale for Bitcoin, every single time we lose that Gaussian channel, all right, lose it, we end up going through, and we end up going to the 200-day moving average first, which we did. And if we lose the 200-day moving average, we end up going to the solid line, which we did. I know a chart isn't showing it, but we went down to 17,500. All right. Now, this is where it gets interesting. When we push back into the Gaussian channel, all right, at some point we will push back into the Gaussian channel. We will see a move right through the Gaussian channel. All right. And that is going to happen again for Bitcoin here. It's happened every single time, right? We see it every time. It's a flip. All right. Just flips the Gaussian channel. So when we look at the Gaussian channel here, we're not saying the Gaussian channel's turned red, we're bearish. It's not what we're saying. What we're saying is the price is underneath the Gaussian channel. We are massively oversold in comparison to the Gaussian channel. We're waiting for the price to re-enter it to signal an entry, because your entries and exits occur when the price either fails to break in or breaks through or breaks below the Gaussian channel. So right now it's not telling us too much, guys. What it is telling us is we can expect the price to move back into it at some point. Don't know when. Doesn't tell us when. When it does happen, then we will know we have an entry. That is how we use the Gaussian channel. All right. So Gaussian channel is ticked off the list. Let's go ahead and take a look at the MACD. And I really don't like using the MACD. I know a lot of people use the MACD. I'm not a massive fan of the MACD just because of how inaccurate and unreliable I'm going to say the MACD can be. You have the periods like this where you see, oh, we got a bullish cross coming, and then Bitcoin goes up one day and then just crashes. Like over here. It really depends. Now, the reason I do sometimes use the MACD and I use it as a tool in conjunction with other indicators. And I use it in conjunction with the 200-day moving average a lot actually, but not on the larger time frames, on the smaller time frames. So generally what we're doing is we're looking for a period where the price gets above the 200-day moving average and we have a positive cross on the MACD at the same time. So positive cross is when the blue line flips the yellow line while above the 0 point level on the MACD. All right, so right now on the larger time frame, what is the MACD actually telling us? It's not telling us too much, guys. It's telling us we have this slow decrease in volume, well, so I say slow increase in selling volume in comparison to buying volume. So every time we see a red candle, that's aggressive selling volume in comparison to buying. Every single time we see a light red candle, it means in comparison to the previous period, the selling volume has dropped in comparison to the buying volume. Every single time we see a green one, it means there's significantly more buying volume than selling volume, and then so on and so forth, right? The same thing for the light green. So that's how it works. So it can be used to identify momentum. It can be used to identify, how the charts are looking. On the larger time frames, I don't really like to use it. On smaller time frames, let's take a look on the daily. It can be used a little bit better. So on the smaller time frame, here we go. We have this crossover on the MACD. Now, the reason this isn't technically, according to the MACD strategy, an entry signal is because although we have a crossover, we're underneath the 0 point line and we're underneath the 200-day moving average. So that means this crossover can have the potential to not actually turn into anything significant. There's no guarantee. So you take it with a grain of salt. That's all we're saying, all right? So let's take a look at the RSI, one of my favorite indicators in the market. It's probably actually my favorite indicator in the market. If anyone ever asks me, Whale, what's your most used indicator? What is your favorite indicator? Hands down, RSI every single day of the week. The RSI is phenomenal at predicting momentum. It's phenomenal at predicting breakouts and when to enter, and even targets for charts. So I love to use the RSI, of course, and we can use it in a whole range of different ways. One of the ways I do like to use the RSI is to draw macro structures and identify breakout points on macro structures within the RSI, identify momentum shifts, apply it to the current price action, wait for confirmation, and then enter trades. The success rate on that is phenomenal when you use it correctly. Anyway, back to this, we have a falling wedge. And we already know what the falling wedge is, guys. It's a bullish pattern. We have 2 touches. We have 3 touches. What does that mean? We have 5 retests. What's the golden number for a retest? 5. You have 5 retests, you have a confirmation of a pattern. So 5 retests within a wedge, confirmation. Price at the bottom, bouncing from the bottom. We have a nice doji candle on the daily, on the 3-day on Bitcoin. We have a nice bounce from the 2017 all-time high. We're back over that resistance zone on the descending channel. The momentum is starting to turn. It hasn't turned yet. We do need confirmation. It is looking favorable. What am I saying here, guys? I'm saying the charts aren't looking horrible. On the macro, of course, everything we're looking at here today is lagging. Everything is connected to the global economic environment. Everything has the potential to get wrecked if the economy continues downwards. And we'll talk about that in just a moment. Of course, I'm going to bring it up. But going back to the Bitcoin chart over here, we can see a few things. We can see a few different patterns forming. And of course, your first most easily identifiable pattern that can really pop out in your head is that inverted head and shoulder pattern. So the inverted head and shoulder pattern, of course, is a bullish pattern, and I haven't really particularly drawn this one in on my Telegram. I'm sticking to my other pattern, which I'll show you in just a second. For some reason I'm struggling to find my inverted head and shoulder pattern. There it is. Okay, so our inverted head and shoulder pattern. Now, there's a few rules that the inverted head and shoulder pattern needs to, I would say, qualify before we can actually determine whether or not it's valid. So first and foremost, left shoulder, right shoulder need to be smaller in distance from the neckline to the base, to the apex, than the head. So we have that. We need 3 distinctive values. We have that. We need a breakout above the neckline. We have that. So according to this, we are in a bullish pattern here, but the target for this would be a distance move of about 2,500 from here. I don't think that's going to happen because, as we identified, and I'll go back to this chart over here, we have a lot more resistance before that point. So generally the price will move out of a breakout to its nearest strong resistance and then head downwards again or consolidate and move upwards. Just because the measured move tells us we're going 25K, it doesn't mean we have a clean shot of 25K. It means that's what the measured move is telling us. We can definitely move up here, reject from here, continue downwards. We could even move up here, reject from here, continue downwards. It doesn't mean the measured move is incorrect, but the measured move doesn't give you a specific guaranteed target. It tells you this is the range of which we could see the price move based on its breakout, but generally we move to the nearest resistance support. We can also sometimes see fake outs of inverted head and shoulders and completely break out of that neckline and then fall back through and never go back up. So, you know, these things have to be considered when doing analysis. And of course, not every single analytical breakout is going to be guaranteed. There's always a degree of error in these analyses, meaning that just because you have an inverted head and shoulder breakout, it doesn't mean the price will continue upwards, guys. There's about an 80% chance that it continues upwards, 20% chance that it goes downwards. It can go downwards. Doesn't matter how good it's looking. Doesn't matter how good the technicals are looking, sometimes it can just go downwards. So we do have a broadening wedge formation over here, and a broadening wedge formation is a bullish pattern. We expect the price to return to that baseline at around 2200 or 2300. Of course, we have that lower target still of 2200, 22,500. So that's what I was expecting here. Now we did say in our Telegram channel, and again, go ahead and join it. We have our upper resistance mid 2200, a drop below the 20,500 level, this dotted line over here. Will invalidate this move upwards because we would have broken back below the neckline and back below the short-term uptrending trend line of the broadening wedge. A drop below $20,000, in fact, will actually confirm a move to that low $19,000 region, which is over here. Okay, guys, so a little bit of information there for that. And I hope today's video has been helpful and a little bit of analysis to shine some light on what's going on, or just to, you know, keep you up to date with the analysis, because we haven't done a technical analysis for a while with them, more market and macro structure analysis. I'm going to go ahead and bring up the snippet from yesterday's video. It's quite a long one, it's 8 minutes. I highly recommend you watch it. If you didn't watch yesterday's video, or you didn't watch the whole video, yes, it was an hour-long video. This is 8 minutes out of that I think is probably the most important 8 minutes that you can watch. It covers a lot of stuff. And of course, guys, if you're interested in trading signals and VIP, go ahead and contact me at the Telegram channel, and you just contact me in the Telegram channel somewhere around up here. Should be a message up here somewhere to say contact Miguel. Here we go, view message, contact Miguel, and we have our VIP channel over here. We post daily trade signals, updates, whole variety of different technical analyses and exclusive market analysis, including 30 to 40 trading signals a month. And you can see our monthly VIP profits over here. If I go to the channel over here, so this is our monthly VIP profits. Sorry, wrong message. Here we go. All right, so in February 2021, we've had 600, 800, 1,000, 3,500. So huge percentages profits every single month. We have never lost a month. We have never turned a month negative. We've been profitable the entire time, including during massive drops in the bear market. With that being said, guys, I'll leave you to it, and I'm going to go ahead and put the snippet in, and we'll end the video. All right, I'll see you in the next one. Let's take a quick look at this. And I want to, before I talk about anything else, I want to go ahead and talk about this. Oh, sorry, my bad. I want to go ahead and talk about this chart over here later, and we'll come back to it because this is quite an interesting one that probably a lot of people have never seen in their life before. We'll talk about it in a second. Before we talk about that, I do want to go ahead and talk about the connection between inflation, interest rates, and asset prices, because this is basically what everyone's assuming is going to cause the leg down for Bitcoin. And Wolf, you were kind of talking about that earlier. You think one of the driving factors to why Bitcoin will lose that 9-year support is obviously the interest rates, correct?
Correct, yeah, to a certain extent, yeah.
Cool, so first and foremost, we have to classify risk. So we're going to come back to this word later on. I just want to mention it now, which is systematic risk. And we'll come back and talk about that later. But systematic risk is essentially risk that is out of an investor's control. So risk that is within an investor's control is the type of assets you purchase, the timing of your purchase, the diversification of your portfolio, and asset classes. Those are things that you can control, you know, percentage allocation between assets. What you can't control is systematic risk. So stuff like inflation, interest rates rising, so I got emails coming in, all that kind of cool stuff, monetary policies, fiscal policies, all that kind of cool stuff, right? All that stuff that we hate. So anyway, inflation has been increasing rapidly, right? That's because there's been a lot of printing of money. I think Wolf talked about that in a couple. I remember like a video from like 2 months ago. You were bringing up that chart every other week with you know, the yields and how much money is being printed every single, you know, in comparison to history. But anyway, going on to divergence over here, there's been a lot of money printed in the last few years, which has resulted in high inflation. Obviously, devaluation of the dollar results in higher inflation. All right, what does that result in? Well, it results in higher costs of goods. So costs of goods and services increase, which means people need to spend more money. All right, so How can the government or how can the economy combat this and bring this inflation down? What they do is they increase interest rates. And I've talked about this a lot on my channel. I've talked about this in basically every collab, but we're going to go into more detail in this today. So I want to quickly give everyone a nice little foundation before we go ahead and do that. So interest rates rise. What happens then? Interest on debt increases. So a lot of companies during low credit periods, so when interest rates are incredibly low, which they have been for the last few years, they acquire a lot of assets on low credit, on low interest. So they acquire these income producing assets on low interest, which means they have income producing assets producing future cash flow, which increases a company's valuation, increases the premiums, increases dividends and stock prices, which is why stock prices have increased. But we also have low interest repayments, which means their debt to service ratios are favorable, so they can continue to take these assets. So they're accumulating income producing assets at a low cost. Now, when interest rates rise, however, it flips. We have interest repayments increasing, debt to service ratios decreasing, future cash flows decreasing, and company stock price falling. What happens when their future cash flows decrease and their available cash flow decreases? They need to decrease their balance sheets by offloading risk assets. What are risk assets? Stocks, cryptocurrencies. All right, liquid assets, assets which can be liquidated into cash very easily. So that is one reason why we're seeing cryptocurrency fall massively and why we have seen stocks fall massively. And that's just the companies. We're going to come back and talk about that and show you a visual representation of why that occurs. Moving on, when costs of goods rise, retail obviously needs to spend more money. All right, they need more available cash flow because things cost more money. Not only that, anyone with long-term debt obligations, car loans, house loans, they need to pay more money towards these loans. So now they're going to be more likely to sell their assets to cash, all right, selling their assets to cash, or not investing in assets during periods of high interest to increase their available cash flows to spend on the cost of living and interest. So the economy is not facilitating, it's not only facilitating growth, it's actually enabling, or should I say, resulting in a degradation of growth or a drop in asset prices. Wolf, we've talked about this a lot. You've got a good grip on that already. You talk about that a fair bit on your channel, I assume. But that's basically the know-how. So let's talk about, I guess, how does that actually relate to this chart? Because this is an interesting one, because a lot of people talk about how cryptocurrency and stocks are, pegged together. And that's just not true. Cryptocurrency and stocks are not tied together. They are tied to a singular thing. So they're not technically tied together. They are correlated by a plus 0.7 positive correlation, not perfectly correlated, which means they move as systemic risk increases. If systemic risk increases, cryptocurrency and stocks return changes. Their beta value change. The risk increases and decreases. So we'll talk about this in a second, but first we need to identify what the chart is. So this is earnings, so potential earnings or return over here. We have our risk-free rate, which is the percentage return at no risk. All right. We have our variation or our standard deviation between the two different asset classes. So the correlation between, and we can see on this chart over here, we have our beta. So the expected return on investment or overall risk. The difference between 0.1 and 0.2, the distance between represents the total risk. So the total risk between assets. The distance between this point, which is stocks, all right, and this point over here is the total systematic risk, all right? The difference in total systematic risk, all right? And the distance in vertical height is not only the difference in return, but also the difference in non-systematic risk. We talked about non-systematic and systematic a few minutes ago. So what have we seen happen? We have seen a scenario where systematic risk has been increasing. Interest rates have been increasing. This has been moving downwards. All right, what does that do? Well, it actually brings this beta higher. So when systematic risk increases, the beta increases for the asset class. And a lot of people get a conception that, cryptocurrency and stocks are correlated to each other or tied or pegged, but that's not technically true. They're not tied or pegged to each other because as systematic risk increases, the returns and risk on both cryptocurrency and stocks increase. All right, the risk on cryptocurrency and stocks increase. So it's not that because stocks are, decreasing, crypto's decreasing, it's because systematic risk is increasing that both of these assets, which are positively correlated, move similarly. Not together, they move similar. So that is a correlation between that. So what happens now when systematic risk decreases, all right, goes the other way, we have this decrease in the beta. So the risk between these assets decrease. So how can we relate this to a chart? And a lot of people think, what the hell is whale even talking about? Well, what is it doing is representing exactly what we talked about here on, I would say, a mathematical chart. And how can we relate that to the Bitcoin chart? Well, if we move down over here and we assume that Feds are going to continue to increase interest rates, we can predict that the beta of these asset classes will continue to increase. The problem with that assumption, it is an assumption that the Feds are going to continue to increase their systematic risk. We don't have a confirmation. They've told us one thing, but there's no confirmation. So what happens if the Feds tomorrow decide, okay, we're not going to increase interest rates by as much next period, and we're going to start increasing our money printing again? What happens? Systematic risk decreases. Overall risk on these assets decrease. They don't decrease because crypto's bottom. They don't decrease because stocks are bottom. They decrease because systematic risk is decreasing, and therefore returns are more favorable. When returns are more favorable, therefore meaning that the risk reward ratio for these assets are more favorable, people start moving money from cash back into assets. And crypto will produce more returns as it's got a greater systematic risk, a greater total risk, and higher earning potential. I hope that makes sense, guys. It's a lot of stuff to talk about there, but essentially what we're doing is we're providing some economic data or evidence to why the price will move in either direction based on the economic environment. Okay guys, so we're going to take a look at Bitget next, and I highly recommend sign to Bitget. This is where I personally trade. So if you want to be trading where I trade on a daily basis, sign to Bitget. In the comment down below, you'll see the referral link. Just go ahead and click that. You can sign up and you get access to our reward center if you sign up. And there's a whole range of things you can do here to basically get rewards. And you know, the rewards bonus is up to $4,163 US, which is pretty significant. But you can go ahead and get access to that if you click the link down below. Beyond that, guys, I really do like Bitget Exchange. I'm not just saying that to shill you guys a referral link. Honestly, sign up without the referral link. I don't care. I'm honestly telling you guys 0.02% trading fees is just too good to miss. You just really can't miss it. It's 0.02%, guys. It's insane. But this is the futures over here, and it's a global exchange that doesn't have KYC, so anyone can access this from anywhere in the world and get access to all the tools. So whether you're in Australia and you generally can't access futures, you can sign up here and get access to futures. If you're in, let's say for example, I think the UK and you can't get access to futures, you can sign up here and get access to futures. If you're in America and you can't get access to Binance or Binance Global and you can't access a lot of their spot trading pairs, they have all the spot trading pairs that Binance has over here plus more. They have over 250 spot trading pairs and all the big ones on this exchange that you can trade, and the liquidity is quite high. So I highly recommend signing up here. And of course, like I just mentioned, you get access to that reward center, there's copy trading, there's a whole range of other things, and go ahead and sign up, guys, because it really is probably the best exchange out there. All right, let's go ahead and get back into the video. Okay guys, I want to take a quick moment to introduce the Become a Trader course at the end of this video. This course was designed by myself and Wolves of Crypto. We put together a whole variety of knowledge to create the most cohesive, understandable, and beneficial trading course there is on the market. If you're interested in learning how to become a trader, if you're interested in learning how to use technical analysis, if you're interested in learning how to apply market analysis to different cryptocurrencies, this is a course for you. We teach you everything from the fundamentals, the basics about what cryptocurrency is, how to trade cryptocurrency, mastering the craft of cryptocurrency, diving into a whole range of technical indicators, market structures, and teaching you how to utilize these when finding trades and applying risk management strategies to become more profitable over time. We even dive into market psychology, human psychology, and provide a variety of different videos and educational content, including courses and quizzes to assist your learning along the way. If this is something you're interested in, guys, go ahead and contact us down below at the cryptoacademycourses@gmail.com. We'll send you an email back with all the course information, the structure, the payment details, and everything else you need to know. That being said, guys, I hope you enjoyed the video today, and we'll catch you in the next one.